Oil isn't trading on supply and demand anymore. It's trading on keywords. And a single tweet just triggered a 5% flash crash in minutes.
That is the urgent warning from George Gammon, host of Rebel Capitalist. He's joined by macro experts like Jeff Snider of Eurodollar University and veteran fund manager George Noble to expose the terrifying fragility in today's markets.
We have leveraged AI to compress hours of these high-level macro discussions into just a few minutes of pure, actionable insights.
Stay tuned to find out which assets could face a 90% wipeout, why the Texas housing market is a canary in the coal mine, and the specific level that signals a massive breakout for silver.
Today, we are breaking down a massive move in the energy markets based on the latest analysis from George Gammon, the host of Rebel Capitalist.
George has been tracking how a single tweet can actually break the oil market, exposing some terrifying fragility in our global systems.
Wait, one tweet? Are we talking about a world-altering policy shift or just someone's morning thoughts?
According to George Gammon, it doesn't even have to be a policy shift. It just has to trigger the right algorithms. The big takeaway from George Gammon is that oil isn't trading on supply and demand anymore. It's trading on keywords. A tweet triggered a 5% flash crash in minutes.
Right, and while oil is tanking now, George warns that the data shows a massive supply crunch coming that could send prices to the moon shortly.
Hold on, 5% in minutes? My gas station doesn't lower prices that fast.
Exactly. George points out that the paper market of futures contracts is totally disconnected from the actual physical barrels of oil.
It's the ultimate open loop, short-term panic versus long-term scarcity.
So basically, the bots are panicking while the world is running out of the real stuff.
George Gammon highlights that roughly 80% of oil trading volume is now driven by algorithms.
These bots are programmed to sell the second they see keywords like ceasefire or increased production on social media.
80%. So humans aren't even making the decisions anymore.
Not in the short term. George says this creates massive liquidity holes where prices just fall into a vacuum.
It's a digital stampede, and the bots are all trying to get through a tiny door at the same time.
That explains why the price swings are getting so violent lately.
George also discusses the Strategic Petroleum Reserve, or SPAR, which is at its lowest level since 1983.
He argues that the government is using it as a political tool to keep prices low during election cycles rather than an emergency buffer.
Wait, 1983? I wasn't even born yet. Isn't that dangerous if we have a real emergency?
That's exactly George Gammon's point. We're draining our insurance policy to make the current numbers look better.
And when we eventually have to refill it, that's going to create a massive floor for oil prices.
So we're selling low now only to buy high later. That's not how you're supposed to do it.
Despite the flash crashes, George points out that actual global demand is hitting records, about 102 million barrels per day.
But investment in new drilling is way down. We aren't finding new oil to replace what we're burning.
If demand is up and we aren't drilling, why is the price dropping on Twitter news?
Because the paper market, the traders, are betting on a recession. They're ignoring the physical reality of the barrels.
George calls this a massive disconnect that usually ends in a violent price correction to the upside.
So the sale at the pump is probably temporary. Great.
Based on George's analysis, we should expect oil to hit $100 again once the SPAR refill starts.
The government will have to compete with regular buyers, creating a massive bidding war.
$100? That's going to make my commute a nightmare.
It's not just your car, it's the cost of shipping everything you buy.
George thinks this is almost inevitable unless global demand absolutely falls off a cliff.
Gammon's second prediction is that these flash crashes will become more frequent as AI takes over the trading floor.
We'll see huge swings of $10 in a single day, based on nothing but rumors and headlines.
So the market is basically becoming a giant video game played by robots.
A video game where your bank account is the high score. Yeah.
Buckle up, because the volatility is just getting started. George Gammon suggests keeping a very close eye on the DXY, the US dollar index.
If the dollar weakens, oil prices usually shoot up. It's a key signal for the next big move.
So if I see the dollar dropping on the news, I should probably fill up my tank.
That, and check your energy investments. It's a major tell.
Also, watch those SPAR levels. Once they stop selling and start buying, the bottom is in.
So we're basically waiting for the government to admit they need more oil.
Precisely. That's the signal George Gammon says will trigger the next major bull run.
Macro insights like these are why people follow the Rebel Capitalist app. Today we're dissecting the live CPI reaction as analyzed by Matt deWolf from Trade Brigade.
Matt deWolf was right on the pulse, watching the numbers drop in real time and showing how the market immediately reacted to the inflation data.
Hold on, CPI? Is that the report that basically tells us if our groceries are going to cost more next month?
Exactly, it's the Consumer Price Index. And Matt's focus was on how the big players in the stock market were going to digest these specific figures.
Let's see if the numbers Matt highlighted actually brought any relief to the S&P 500. The single biggest takeaway from Matt deWolf's analysis is the flat headline CPI, coming in at 0.0% month over month.
That's massive. Wall Street was expecting 0.1%, so a big round zero is a major win for the bulls.
Wait, zero? So inflation just stopped for a month?
On a monthly basis, yes. Matt points out that this could be the start of a cooling trend the Fed has been praying for.
It's a huge relief, but Matt also warns that while the month was flat, the year-over-year is a different story. Matt deWolf highlighted that year-over-year inflation came in at 3.3%, beating the expected 3.4%.
That 0.1% might seem small, but in the macro world, it's huge. Matt noted the S&P 500 futures immediately spiked on the news.
So if the number is lower, the stocks go higher. Why is that?
Lower inflation means the Fed might finally cut interest rates. Matt's charts showed a massive green candle the moment the data hit the tape.
Matt was watching the 5,400 level on the S&P like a hawk during that surge.
So basically, everyone just started buying at the same time because of a 0.1% difference.
According to Matt's live tracking, the Nasdaq didn't just bounce. It shredded through previous resistance to hit new all-time highs.
Matt deWolf was looking at those tech stocks specifically, noting that they are the most sensitive to these interest rate vibes.
Wait, fresh all-time highs? In this economy? I thought everything was expensive.
It is, but the stock market looks forward. Matt explains that if inflation is cooling, the higher for longer rate narrative starts to crumble.
He emphasized that the tech heavyweights like Nvidia and Apple were leading the charge.
So my phone and my graphics card are basically driving the whole market up.
Matt deWolf also kept a close eye on the 10-year Treasury yield, which tumbled below 4.3%.
Yields falling is like rocket fuel for stocks. Matt mentioned this was a textbook reaction to a cooler than expected CPI print.
Yields, rates. My head is spinning. Why does a lower yield make me want to buy stocks?
Think of it this way. If the bank pays you less to just sit on your cash, you're going to go look for better returns in the market.
Matt's take was clear. The drop in yields confirmed that the market believes the inflation dragon is finally being tamed.
Okay, so lower yields equals more YOLO into the S&P. Got it.
Matt deWolf predicts that if the S&P 500 can hold the 5,400 level, we could be looking at a sustained summer rally.
His analysis suggests that the buy the dip mentality is back in full force now that the inflation scare is receding.
What if it doesn't hold? Does the whole thing come crashing down?
Matt warned that a fake out is always possible, but with these numbers, the path of least resistance is definitely higher.
He's watching for any signs of the Fed throwing cold water on this optimism at the next meeting. Matt deWolf sees these CPI numbers as the green light the Fed needs to start considering a rate cut as early as September.
Before this report, it was a toss-up. Now Matt notes the market is pricing in a much higher chance of a pivot.
September? That's just a few months away. Will my credit card interest actually go down?
Eventually. Matt's point is that the market reacts now, but the real-world impact takes time to filter through.
It's all about the trend, and Matt says the trend for inflation is finally pointing the right way.
For the traders out there, Matt deWolf recommends keeping a close eye on 5,375 as a key support level.
If we stay above that, the bullish trend remains intact. Matt says, don't fight the trend when it's this strong.
So, if it hits that number, is that when I buy or when I run for the hills?
Matt's data suggests it's a zone to watch for buyers to step back in. Finally, Matt deWolf suggests watching the US dollar index. A weaker dollar usually supports higher stock prices.
The dollar took a dive right after the CPI print, which Matt signaled as a classic risk-on move.
So a weak dollar is good for my stocks, but bad if I'm traveling to Europe.
Exactly. You win on the portfolio, you lose on the vacation.
Thanks to Matt deWolf for the deep dive on these levels. It's going to be a wild week.
Today, we're breaking down a massive warning from George Noble, a veteran fund manager who told David Lynn that certain assets could see a 90% crash.
George has been around since the 80s, so when he says this is the biggest bubble of his career, we should probably listen.
Wait, 90%? As in, my $10 becomes $1. That's not a correction, that's a wipeout.
Exactly. George Noble isn't talking about the whole market, but he's hyper-focused on the everything bubble created by years of cheap money. George Noble's core thesis is that the era of zero interest rate policy, or ZIRP, is officially dead, and it's taking the bubble with it.
Right. For a decade, money was basically free. Now that rates are rising, the math for overvalued tech and long-term bonds just doesn't work anymore.
ZIRP? Sounds like a cartoon character. Can we put that in English? Why does free money disappearing break everything?
Think of it like gravity. When interest rates are zero, stock prices can float to the moon. When rates go up, gravity kicks in and those high flyers come crashing down.
And George told David Lynn that many investors are still in denial about how much gravity has actually changed. One of George Noble's biggest red flags is the bond market. He says the 40-year bull market for bonds is finished.
That's huge because for decades, bonds were the safe part of your portfolio. George is telling people to stay the hell away from long-duration treasuries.
Hold on. I thought bonds were where you hide when stocks get scary. Is George saying there's nowhere to hide?
Pretty much. If inflation stays high, those old bonds with low yields lose value. You're basically holding a wasting asset.
He emphasized to David Lynn that the traditional 60-40 portfolio is essentially a trap in this new environment.
George also highlighted unprofitable tech companies. These are the story stocks that don't actually make money, but promise the world.
He's looking at drawdowns of 70, 80, or even 90% for companies that were trading at 50 times revenue.
50 times revenue? I don't even pay 50 times for a pizza. Why would anyone pay that for a company that loses money?
Because they were betting on future growth. But as George points out, when the cost of capital goes up, future growth isn't worth as much today.
It's the ultimate reality check for Silicon Valley darlings. Noble also warned about the massive concentration in the S&P 500. A few giant tech companies are carrying the whole team.
It's the danger of passive index investing. People think they're diversified, but they're actually just loaded up on the same 5 or 6 stocks.
So if those big 5 stocks slip, the whole index goes down with them.
Exactly. George Noble believes the passive bid that pushed these stocks up will eventually turn into a passive sell that drags them down.
He's essentially saying the safety net of index funds has become a noose. In George Noble's view, we're entering a macro market. The days of just buying an index fund and chilling are over.
It's a stock picker's market again. You have to actually look at balance sheets and cash flow, not just follow the trend.
Wait, so I actually have to do homework now? I can't just click buy on whatever is trending on TikTok.
Unless you want to follow George's prediction of a 90% loss. Yeah, homework is back in style.
He predicts a massive shift away from growth and back toward value and real assets. George doesn't think the Fed can just pivot and save everyone this time. Inflation is too sticky.
He expects volatility to stay elevated because the Fed is trapped between fighting inflation and trying not to break the economy.
So it's going to be a bumpy ride for how long?
George's analysis suggests this cycle could take years to play out, not just months.
Buckle up because the buy the dip strategy might just lead to more dipping.
George Noble's final advice in his talk with David Lynn was clear: prioritize capital preservation.
In a crash, the winner is the person who loses the least. Cash and short-term instruments might actually be your best friend right now.
So basically, don't be a hero. Just try to keep what I've got.
Exactly. George says to avoid the hot sectors and look for safety until the dust settles.
Keep an eye on real interest rates. If they keep climbing, those long-duration assets, like 30-year bonds and tech stocks, will keep hurting.
Real interest rates. That's the rate minus inflation, right?
Spot on. If that number is positive, it changes the entire game for investors.
George Noble's warning is a wake-up call to stop ignoring the macro reality. The bubble has no more air left. Today, we are breaking down a massive warning from Chris Vermeulen, the founder of the Technical Traders and a veteran in technical analysis.
Chris has spent decades studying chart patterns to predict major market shifts, and he says we are currently seeing every textbook sign of a market top.
A market top? Wait, so does that mean the party's over for my retirement account?
Well, Chris says there is likely one more blow-off move coming before the floor drops out, which is exactly what we're diving into.
According to Chris, we're looking at patterns that mirror the 2008 and 2000 bubble peaks.
The alpha here is that the market is overextended and the smart money is already eyeing the exits.
If the smart money is leaving, I don't want to be the last one holding the bag. What are the charts actually showing?
Let's look at Chris Vermeulen's data on exhaustion moves and why this peak looks different than the rest.
Chris Vermeulen's main thesis is that we're waiting for an exhaustion move, a final, frantic rally before a 20 to 40% crash.
Right, it's like a runner sprinting for the finish line before collapsing. Everyone piles in at the very top because they're afraid of missing out.
Wait, 20 to 40%? That's not a dip, that's a crater.
Exactly. Chris points out that these blow-off tops are designed to trap retail investors right before the trend reverses.
Chris notes that while the S&P 500 is hitting new highs, the momentum isn't keeping up. That's a huge red flag.
It's a classic divergence. Prices go up on lower volume and weaker momentum. It's a house of cards.
So the prices are high, but nobody's actually buying the hype anymore.
Precisely. Chris Vermeulen calls this thin trading. While tech stocks look great, the rest of the market is actually starting to wobble.
A key point in Chris's analysis is the lack of breadth. Only a handful of tech stocks are doing the heavy lifting for the entire S&P 500.
If you take out the top 7 tech stocks, the market looks almost flat. That's not a healthy bull market.
So if Nvidia or Apple sneezes, the whole market catches a cold.
More like pneumonia. Chris warns that when these leaders finally roll over, there's no safety net underneath.
Interestingly, Chris Vermeulen is seeing big money rotate into defensive sectors like utilities and healthcare.
That's a risk-off signal. It means the big players are bracing for impact by moving into boring, stable stocks.
Utilities, like electric companies, that sounds like the opposite of to the moon.
It is, but when the S&P 500 drops 30%, boring looks pretty beautiful.
Chris also highlights the VIX, the market's fear gauge, which has been sitting at historic lows.
Wait, isn't low fear a good thing? It means everyone's happy, right?
In the stock market, when everyone is too happy, that's when you should be terrified. It's called complacency.
Chris says this lack of fear is usually what you see right before a black swan event or a sudden liquidation. Chris predicts a massive 30% pullback once this final exhaustion move finishes its run.
He's looking for the S&P 500 to hit one more peak, maybe a 5% spike before a vertical drop.
5% up, then 30% down. That's a terrible trade-off.
That's why he's warning investors not to chase this current rally. The risk-to-reward ratio is completely broken.
Chris Vermeulen also sees a big opportunity in gold, predicting a 10 to 15% surge as a safety play.
So gold goes up when the stock market goes down? Like a seesaw?
Often, yes. When people panic, they run to hard assets. Chris thinks gold is setting up for a multi-year breakout.
So the plan is, watch for the blow-off, avoid the trap, and maybe look at gold as the life raft. Chris suggests keeping a very close eye on the VIX. If it spikes above 20, the crash is likely underway.
Right? That would signal that the complacency has ended and the panic has begun.
VIX over 20. Got it. I'm putting that on my watch list right now.
Smart move. It's the best early warning system we have for this kind of volatility.
The final takeaway from Chris Vermeulen: it's time to take profits in high-flying tech and build your cash reserves.
Wait, cash? But inflation is eating my cash. Isn't that bad?
Inflation is bad, but losing 30% of your portfolio in a week is worse. Cash gives you the power to buy at the bottom.
Exactly. Chris's analysis suggests that cash isn't just a place to hide. It's the fuel you'll need to buy the dip when the crash is over. The headlines are all about gold, but Gary Wagner is sounding the alarm that silver is actually the one to watch right now.
Exactly. Gary's latest analysis on Kitco News with Michelle Macquarie suggests silver has much more room to run because its technical base is incredibly solid.
Wait, isn't silver just the cheaper version of gold? Why would it be stronger?
It's about the chart patterns. Gary notes that silver has been consolidating longer, meaning when it breaks out, it's going to be explosive.
So while gold is hogging the spotlight, silver is basically the quiet overachiever in the corner.
I like the quiet ones. Tell me more about this explosive potential.
Gary Wagner isn't just guessing. He's a veteran technical analyst who uses Japanese candlestick charting to spot these shifts before they happen.
Candlesticks, like for a birthday cake?
Not quite. It's a way of reading price action that shows the battle between buyers and sellers.
And right now, Gary sees the buyers winning the long-term war for silver.
Okay, so he's got the receipts. What's the big alpha we're looking at here?
Here is the alpha. Gary Wagner believes silver's technical breakout is imminent and will likely outpace gold's percentage gains.
He's looking at the $30 level as a major psychological and technical barrier that's about to crumble.
$30? Is that a big deal for silver?
It's huge. It's been a ceiling for years. Breaking through that is like breaking a dam.
But hold on. Gary also mentions a massive risk for gold at the $2,400 mark, which we'll get into shortly.
A dam breaking and a gold trap? This is getting intense.
Gary points out that silver isn't just a shiny metal, it's an industrial powerhouse. Demand from EVs and solar panels is through the roof.
Right, silver is the most conductive metal. You can't build the green energy transition without it.
Wait, so my electric car has silver in it? How much?
Enough that as EV production doubles, silver demand goes vertical. Gary thinks this fundamental floor is what makes the technical breakout so certain.
So unlike gold, which mostly just sits in a vault, silver is actually being used up.
So we're running out of it while needing it more. That sounds like a price hike waiting to happen.
Gary Wagner also highlights the gold to silver ratio, which is sitting around 85 to 1.
85 to 1. Explain that to me like I'm 5.
It means it takes 85 ounces of silver to buy just 1 ounce of gold. Historically, that's incredibly high.
Exactly. When the ratio is this high, silver is considered dirt cheap compared to gold. Gary expects that ratio to shrink as silver catches up.
So silver is basically on sale right now?
According to Gary's analysis, yes. It's the bargain of the precious metals world. Let's talk levels. Gary and Michelle discuss the $30 mark as the ultimate line in the sand.
If silver can close above $30 and stay there, Gary predicts a run toward $34 or even $50.
$50. That's almost double. What's stopping it?
Major sell orders are parked at 30. It's a psychological battleground.
But Gary's charts show that the selling exhaustion is kicking in. The bears are getting tired.
Tired bears mean happy silver owners. I'm liking this math.
So if that $30 wall falls, what's the first stop on the moon mission?
Gary's first target is $34, followed quickly by the all-time highs near $50.
Wait, $50 was the all-time high. When was that?
Back in 2011 and 1980. It hasn't been there in over a decade.
Gary believes the current economic setup, inflation plus industrial demand, is the perfect storm to finally break that record.
So we're looking at potentially a once-in-a-decade move here.
Now, about that gold trap Gary mentioned to Michelle.
Right. Gary sees massive resistance at $2,450 for gold. He thinks it might stall there while silver takes over the lead.
So gold hits a ceiling, while silver is breaking through its roof.
Exactly. That's why Gary is leaning so heavily into silver for the next phase of this cycle.
It's a rotation. Money is going to flow from the expensive metal to the undervalued one.
Got it. Buy the laggard, ride the wave. Simple enough.
So what's the actionable move? Gary says watch the weekly close for silver.
Don't get fooled by a midday spike. You want to see silver finish the week above $30.
Wait, why the week? Why not just check my app on Tuesday?
Because big institutional players move on weekly trends. Gary uses that to filter out the noise of daily trading.
And keep an eye on that 85-to-1 ratio.
As Gary explained, if that ratio starts dropping towards 70 or 60, silver is in a massive bull run.
So if the ratio goes down, my silver goes up?
Usually, yes. It's the best indicator Gary uses to see if silver is finally outperforming gold.
Alright, I'm setting my alerts. $30 or bust.
Today we are looking at a massive housing market warning for Texas based on the latest analysis from Jeff Snider at Eurodollar University.
Jeff has been tracking the global monetary system for decades, and he says what is happening in the Lone Star State is a precursor for the rest of the country.
Wait, Texas? I thought everyone was moving there because it was the one place where things were actually affordable.
That was the old story. Jeff Snider is showing that the Texas miracle is hitting a wall, and it is hitting it hard. The core of Jeff Snider's thesis is that the supply-demand balance has completely flipped, with inventory skyrocketing over 40% in some areas.
Specifically in cities like Austin and Dallas, the sheer volume of homes sitting on the market is reaching levels we haven't seen since the Great Financial Crisis.
40%. So sellers are just stuck with these houses now?
Exactly. Jeff explains that when inventory spikes this fast, prices have nowhere to go but down.
And while Austin is the poster child for this, Snider believes this is a national trend that is just starting in the South.
So the sold in 2 days era is officially over.
Jeff Snider points to Austin as the canary in the coal mine, where prices have already fallen nearly 20% from the peak.
It is a massive correction. The town that couldn't stop growing is now leading the nation in price drops according to Snider's data.
Hold on. If my house lost 20% of its value, I'd be panicking. Is this happening everywhere else?
Not yet, but Jeff's point is that Texas usually leads the cycle because they build more houses. More supply means the price drops hit there first.
So it's not just a Texas problem, it's a supply meeting reality problem.
I guess the Keep Austin Weird slogan now applies to their real estate charts too.
According to Jeff, it isn't just about rates, it's about banks getting stingy with credit.
Right, even if someone wants to buy, Jeff Snider highlights that banks are tightening standards, making it harder to get those six-figure loans.
So if the rates don't get you, the bank's paperwork will?
Pretty much. It is a double whammy of high costs and restricted access to money.
Jeff's analysis suggests this is why the rebound everyone expected this year hasn't actually materialized.
It's like the market is stuck in a giant traffic jam with no exit in sight.
A key takeaway from Jeff Snider is that the monetary system moves slowly. It takes 12 to 18 months for rate hikes to really bite.
So we are only just now feeling the effects of what the Fed did a year ago.
Wait, you mean the pain is just starting? I thought we were almost through the woods.
Snider argues we're just entering the woods. The inventory builds up slowly, then all at once the market cracks.
It's that classic long and variable lag that Jeff is always warning about in his Eurodollar research.
Great, so the economy has a very slow reflex time. That's not comforting at all.
Jeff Snider predicts that the lock-in effect, where people stay in their homes to keep low rates, is finally starting to crumble.
He expects that life events like jobs, divorces, or just needing more space will force more homes onto the market, even with high rates.
So the dam is finally going to break.
That is the prediction. As more people are forced to sell, that 40% inventory spike we saw in Texas could go national.
And when that happens, the supply-demand balance shifts permanently in favor of buyers.
Good for me if I'm buying, but I'm guessing bad for everyone else.
Jeff warns that housing is a lead indicator for the broader economy. If housing falls, a recession is rarely far behind.
His research suggests that a decline in home values reduces consumer spending through the wealth effect.
Wealth effect? You mean people spend less because their house is worth less on Zillow?
Exactly. You feel less wealthy, so you don't buy that new car or go on that vacation.
And that's how a Texas housing warning turns into a national economic slowdown.
So my Zillow addiction is actually a form of psychological economic warfare.
Jeff Snider's advice is simple. Don't look at national averages. Look at your local inventory.
If days on market are rising in your zip code, that is your signal that the Texas trend has arrived.
So I should be checking the for sale signs in my neighborhood like a hawk.
Yes, when you see 5 signs on one block where there used to be none, you know the market has flipped.
Finally, Jeff warns not to expect a quick V-shaped recovery this time.
The monetary imbalances Jeff tracks suggest this could be a multi-year adjustment period for housing.
So no get rich quick in real estate for a while?
Not according to Jeff Snider. It is time to get defensive and watch the data.
Got it. I'll put my dreams of flipping houses on ice for now.
Probably a smart move.
First up, Jeff Snider. His core thesis is the Texas housing market is facing a downturn.
Exactly. He argues that the end of the housing boom is mainly because of stricter lending practices.
So, if you're thinking of buying in Texas, maybe hold off for now.
Yeah, better to sit tight until those credit conditions improve.
Next, we have Gary Wagner, who is optimistic about silver.
Right, he believes that silver's setup is explosive because of its current undervaluation and increased industrial demand.
So he's basically saying silver is the next big opportunity.
That's what he's hinting at, yes.
And then there's George Noble, who states that we are witnessing the death of zero interest rates.
Yes, he argues that this shift will fundamentally change how we invest and think about returns.
So time to move from bonds to more volatile assets then.
Potentially as yields become more attractive in different areas.
Interestingly, all three agree on one crucial point. The markets are extremely fragile.
Right? Whether it's housing, silver, or interest rates, they all point to current volatility as a significant red flag.
So, we're all on shaky ground here, huh?
Exactly, which means investors need to tread carefully. Both Jeff and George highlight that economic policies are key to understanding market trends.
Yes, Jeff discusses the tightening of credit, while George talks about monetary policy and interest rate changes.
So really it all comes down to what the Fed decides to do.
Pretty much, the Fed will be a major player in stabilizing or shaking up the markets. Now for a bit of a clash, Jeff sees a stagnation in the housing market.
But on the flip side, Gary is bullish on silver's short-term prospects.
So basically, one thinks we're going to face a tough sell in real estate, while the other sees a shiny opportunity in silver.
Exactly. It's a classic case of one man's trash being another man's treasure. On the interest rate front, George argues that rates need to rise to control inflation.
In contrast, Jeff believes maintaining low rates is crucial to navigating systemic risks.
So what's it going to be? Higher rates or the same old game?
It's a back and forth that could dictate our financial future. If you found our exploration of these diverse insights valuable, make sure to like, subscribe, and hit that notification bell.
We break down complex financial discussions so you can stay informed without the hassle.
Trust me, this is way better than scrolling through boring articles.
Join us next time for more expert insights that keep you ahead of the curve.